Hey everybody, welcome to this week's episode of the Lumber Word, number 114. Greg, Charles, welcome. Glad to be recording this on the 19th of March. We got a great guest that we will jump in right after we go over a few things here. So Greg, let's jump right into housing starts and permits that came out this week.
Housing starts came out for the month of February, 1,000,005. They revised January a little lower. Permits were 1,456. I got year-to-date starts at down 2.8%, and year-to-date permits down 6.9%. I think it was consistent with what we talked for the demand side. The demand side is, hey, sharply sideways. If we hit steady, big builders are going to continue to build stuff. We're hoping that we get a bottoming in multifamily, which I think we will see. After being down 40% last year. So, that's it's nothing special on that, Ash.
Sounds good. Sounds good. Lumber wise, it's great having a guest on this week. Not only that he's kind of cutting edge on a bunch of this mortgage information going around, but we don't have to talk about tariffs and all kinds of other stuff during this conversation.
Thank you, Lord.
That seems to take up a lot, but just a real quick summary of the market. Charles, pine kind of still trying to find its way. You can probably get more 2 weeks or sooner at most mills. Am I wrong there?
No, you're about right. 6 inches is a little soft, but I think that's across the board in all species, right? Because it had quite a bit of run a lot faster than 4-inch had the elevation in price. 4-inch is kind of firmed up depending on lengths. Obviously, 12 and longer is a little stout, but there's not a lot of buildup, and I think mills are pretty confident in where their order files are, and it gives them a sense of price continuity.
So I heard something interesting on Southern Pine and kind of lived it a little bit here. And Greg and I have lived it logistics right now.
Nightmare.
What I'm hearing in the South are people that thought they had money in loads of Southern Pine are losing money on orders now because logistics is getting tight on trucks everywhere. We had some loads in Louisiana that I thought were going to be $2,800 up to a location. They're $3,500 now. Greg and I are working on shipping stuff out of the Northeast. Two things happening. All the tariff talk, I can guarantee a truckload of aluminum or steel is going to probably pay a lot more money than a truckload of lumber. And two, there was some issues with, I don't know if it's fake news or not, in the South over the weekend. They said some people were getting pulled over and asking whether they could read something in English or write something in English. If there's a fear of that out there, you're going to lose.
That was in Arkansas. That was in Arkansas.
Yeah, it was in Arkansas. You got to stay on the conspiracy side of Twitter.
The conspiracy. Well, I'm on it quite a bit. So, but the point, just even the threat, even the fear of that. If you knock 10% of the drivers out of a certain lane, it raises the price substantially, right?
25 to 30%.
And it's seasonal also. Seasonally trucking tightens up in March, April. So
that's true. Why every year do we forget about that? And seasonally, you got a guy with a lawn blower in your backyard, too.
What's that?
You got a guy with a lawn blower in your backyard here.
Yeah. It's great timing. It's great timing.
Just real quick, spruce. We noticed 6-inch. Everybody wanted to move 6-inch out of the east. I don't know enough about the west. 4-inch. There were some things that were trading if they could load cars. A lot of mills were off the market or not quoting. Studs are still great. 9-foot, 8-foot. 2x4, 2x6 from what we're seeing, especially along the East Coast. They may have had a little pressure in the Midwest because some of the mills like putting a lot of wood in the ground there. Matt, how about in the U.S. species?
Can you hear me?
Yeah, we can.
Yeah, can you hear me?
Species, what happened there this week?
Yeah.
Yes.
And is
you hear
healthy.
Us.
So, oh yeah, I can hear you guys. Studs are good. The pace has slowed a little bit, but the price of them is elevated, and right. So, I like the stud market. I think it feels pretty solid.
All right. I'm going to bring our guest in since that's what everybody's interested in listening to. So let me fire him up here. John, welcome to the Lumber Word.
Thank you.
You didn't get to meet Matt. You didn't get to meet Matt yet. Matt's a Portland guy. You met the rest of us. So I discovered your Twitter. I guess we can't call them tweets or X posts a couple weeks ago, and I started reading them. And I'm like, well, this has got to be kind of a joke, right? This is. I literally thought it was. I thought it was like a satire when you started reading the stories of the different homes, and then I followed you. There was that Wall Street Journal report that came out, like somewhat similar to what you were talking about, but in my opinion, I think you follow the statistics the data a little differently. But so, John, it's Comiskey, correct? Is your last name?
That is correct. Yeah, just like the ballpark in Chicago.
So John is originally. Did you say you're from PA originally, and then moved to Jacksonville, or where?
Maryland.
Maryland.
Baltimore, yeah.
And so, father worked for the CSXT. We all know the rail side. You were in a pretty cool niche industry, data for mortgage originators, mortgage brokerage companies, and so forth. And for a long time, you helped create a lot of the algorithms and data sets, so to speak, for some of the big companies. What was the big one you worked for? Black Knight, is that correct?
I did. Spent many years with Black Knight helping to create, design, and develop basically the systems used to lend.
Were you the guy in The Big Short, John? Were you the guy in The Big Short?
No, although I'm kind of doing a similar thing to what he's doing. Unfortunately, it won't have the same economic rewards for me. I don't think that it had for that guy.
Yeah.
Interesting. So you basically, as we talked in a phone call, you quit your day job, you quit your W-2 job.
Yeah.
Just real quick, I thought it was also interesting. You also are creating a model for money going in and out of the Fed. Is that right?
Yeah. So specifically, the U.S. government's bank account at the Fed, the Treasury General account. I model what it's going to do from day to day, which reflects taxes coming in and government spending going out. And I do that to project like what the Treasury's funding needs are going to be, so how much debt they're going to raise, and then it also works out really well for projecting the X date, which the X date, the debt ceiling, when the U.S. government will run out of money in August if they don't raise it before then.
And then you decided to start really digging into some of the data you were familiar with, which is mortgage data, especially FHA mortgages. But I think since a lot of people are on different sides of the scale on knowledge at all in the mortgage industry, and it's something we rarely do. Could you walk us into the FHA part of it by just, when I'm going to get a loan, how does that start and where does it go to?
And John, I got to understand, you need to talk to Matt like he's a Labrador Retriever.
Golden Doodle.
Yeah, exactly.
All right. Well,
and I'm Matt. That's only because that's the way you tell me to talk to you, right?
That's how I told John to talk to me also.
All right, I will give it my best shot. So mortgage lending 101. So who are the mortgage lenders, right? Sometimes they're banks. Most of the time these days, they are not banks anymore. They're kind of companies that are dedicated to do mortgage lending, or maybe both mortgage lending and then the servicing of the mortgage. They have different models that they do it by. You've got your what's known as your retail lenders that'll have branches. Sometimes you'll see a Loan Depot store in a strip mall, or you'll have like Rocket, which is doing primarily direct to consumer over the phone or through the web. You have a few other lenders who work with mortgage brokers, and mortgage brokers are typically like the local folks that are sponsoring maybe little league teams, and you get to know them, and you go into their office, and then they take your information, but ultimately they're not bringing the money to the table. Companies like United Wholesale are, and they've got a whole model where they work with a bunch of brokers, builders. A lot of builders have dedicated lending companies that are affiliated to them to help provide mortgages to people who are purchasing their homes. So there's lots of different types of lenders, and there's different types of products. But there's one kind of commonality to pretty much all the lenders, which is as soon as they originate that loan, they want to sell it as quickly as they can to get that money back so that they can then lend it again to the next person. And so I said there's different types of products, right? There's different types of products, mortgage products that are geared to different types of borrowers. You have what are known as like the conventional loans. Probably heard of Fannie Mae and Freddie Mac. They buy essentially conventional loans from those lenders when they originate it. You also have VA guaranteed loans and FHA guaranteed loans. There are a few others, but those are the primary products that are out there in the mortgage.
Like those are all government entities. Fannie Mae, Freddie Mae, FHA. What percent of all the mortgages ultimately go to them?
Oh, almost all. Right.
Okay. So 100%.
Yeah.
Government is actually the primary, the end up lender on the vast majority of all mortgages created.
They buy them all up for the most part.
Yeah. Okay. Got it. Okay. That's right.
And that goes back to our conversation a month ago on the show, Charles, when you're like, when are those two entities going to be privatized potentially?
Well, yeah, that kind of plays into. It's interesting you bring that up, Ash, because I saw something today. There's supposed to be. This reporter was at a Freddie or Fannie office. 2,900 people in this building. There was only 42 that showed up full time. That's probably another reason why they can't privatize it.
That was housing. The federal.
No, it was a Fannie office. Crazy,
all right, so
crazy enough.
So all of these mortgages get repackaged and all that, and we talked about there's agricultural ones where if you're living in a rural community and you get that's, and then those fall under a different guideline. Then there's VA, which you're a veteran or in the military, they fall under things. Then there's FHA, which what changed in 2019. And like I said, you're going to have to explain it to me like I'm a Labrador. What changed with the lending practices or standards with the FHA loans in 2019-20 that really got us to this conversation we're having right now?
Okay. And interestingly, it's not really so much about the lending standards.
Okay.
Like when you hear that, you hear the underwriting standards. And to be sure, like FHA in the universe of like Fannie and Freddie versus VA versus FHA, the FHA borrowers are the riskiest borrowers from a credit perspective. They've got much lower credit scores typically. They've got much higher debt to income ratios, which is kind of the amount of money that the borrower of their income that they have to spend on the mortgage, right? So you want that debt to income as low as possible from a credit worthiness perspective. So FHA, they're kind of geared. Historically, they were geared for first-time home buyers. These are the riskiest of borrowers to lend to.
So most FHA loans are first-time home buyers and starter homes, or is that wrong, or is that?
No. That is historically been correct and is still mostly the case. There are some extreme examples that are in the contrary, one or two, which I'll show. But that still is primarily true with the FHA loans. And so over time, since like 2010, in the FHA portfolio, two things. A, it's become a more prevalent. There's more FHAs now. They've got more market share in the more overall mortgage market than they did back in 2010. And it's true, right? Like that the credit worthiness stats, if you will, of the borrowers has been deteriorating steadily over time. So the DTIs, the debt to incomes, are getting higher. And you're getting kind of riskier borrowers than you used to have. But that isn't really what the issue is. The problem is actually with what's known as the loss mitigation procedures. So what's loss mitigation?
So basically, loss mitigation, Charles, Matt, Greg, Ashley can't pay for their house. And if they got a conventional mortgage, we know what happens. But if they've got an FHA loan, like, there's different ways to mitigate that now, correct?
Yeah. And to be honest, a conventional loan, they have loss mitigation procedures too. Like all of the different, Fannie, Freddie, VA, FHA, they kind of each have their own set of loss mitigation procedures. And being fair to the FHA, almost all of them made them very, very permissive when the pandemic hit. I mean, the focus in the industry was making sure that servicers didn't go bankrupt because they had to continue to make the payments to the investors, regardless of whether or not the borrower is paying. And while they'll eventually get that money back, that's a liquidity concern for servicers. So there was a focus on making sure servicers stayed liquid, and then B, borrowers stayed in homes. That was kind of the focus during the first, as the pandemic unfolded, and then in the year or so afterwards, as we were kind of figuring it all out.
How did that loss mitigation change in those years? Like what did it go to, and how did it change?
Yeah. So specifically, a couple of the key changes were, one, the FHA introduced, they already had what was known as a standalone partial claim, and I'll explain exactly what that is here in a minute. But what they did is prior to the pandemic, you couldn't string these standalone partial claims together, one after another, and basically keep getting them without ever making a mortgage payment. That was something that wasn't possible under the FHA loss mit procedures prior to the pandemic. But then they opened it up. They opened it up where you could do that, and problematically, they never closed that. They never closed that loop, and still haven't. And so, what a partial claim is we'll take Charles, perfect example. Charles is not paying his mortgage. He gets 4 or 5 months behind. The entity that's servicing his mortgage is going to call him up. Charles answers the phone. Servicer's going to say, "Hey, Charles, can you resume? Can you afford to bring your loan current, to make the 5 missed payments that you haven't made?" Charles says, no, he can't, but that he can make the payments going forward. He just can't cover what he's missed. Then what the FHA will do is they will reimburse the servicer the 5 payments that Charles didn't make over that time. And then, voila, the loan is now current and Charles goes on.
Where does that principal get back and loaded into the actual principal or anything? Or is that,
So what the FHA gets is they get a junior lien that is repayable at the maturity of the mortgage, or if Charles sells his house, or if Charles refinances, then that would the proceeds from that would cover the junior lien. Notably, that junior lien is interest free. So it's actually pretty advantageous to the borrower because you're effectively getting an interest-free, 26 to 30-year loan, which is a pretty sweet loan to get. And all right, so Charles does this. Great, Charles is current again. And if Charles pays, then fine, right? Like, these partial claims are an effective loss mit procedure to help a borrower who really has a genuine temporary rough spot. Say Charles lost his job and he needed some time to get another one before he could resume.
That's the intent. That's the intention.
Yes, 100%.
Yep.
The problem comes about that Charles doesn't have to prove that he's actually going to start making mortgage payments again. And so let's say that Charles doesn't, and he misses another 4 or 5 payments, and the servicer calls him up again, and it runs through the same script with Charles. Hey, Charles, can you afford to bring your mortgage current? Nope, sure can't. Well, can you resume your payment? Yes, I can. FHA pays the servicer for those 5 more missed payments, brings Charles current, rinse and repeat. And this was not previously doable under the pre-COVID loss emit procedures for the FHA. And while you could maybe understand it, during the pandemic and in the immediate time frame afterwards, the reality of it is it's been like this ever since, and it's still like this, and it will be like this for a little while yet.
So this loophole still hasn't been closed.
100% has not been closed.
That's a problem.
You think?
Good grief.
How many mortgages are out there that have had multiple loan loss mitigations? How many mortgages are out there that fall into this category that this has happened more than once?
So basically size it up, right?
Yep.
So I don't have that exact stat, but I can tell you what happened in February. In February, there were about 31,000 new partial claims that were done, and about 14,000 of them were repeat partial claims. So the borrower had gotten a partial claim at some point in the past, and if memory serves, it's about 8,000 of them received a partial claim in the last year, within the last year. So they're getting a second partial claim within a year's time frame. And these partial claims typically will cover, it can be anywhere from 4 to as many as like 20 payments, depending on how quickly the servicer connects with the borrower on it. Typically, they're probably 6 or so is what the average length of or number of payments that a partial claim, based off of the data that I see.
Where do you pull this data from? Where do you how
he can't reveal all his secrets, Ash? I mean, that's
it's
asking the man what's in the juice.
No, but I'm really curious because John, you mentioned something to me when we were talking about, hey, I think people that are looking at this data are interpreting it incorrectly, and I may be interpreting it differently. Did I hear you right when you said that to me a little bit? The way it's, or did I?
Yeah.
Okay.
Yeah. So, there's a couple of different data sources for this, right? Like the FHA provides performance data on their entire, on all of their loans. They do it. It's every month, but it's with a couple months lag. But they're just giving you high level numbers. Like here's the delinquency rate, which would be anybody who is late by a month or more. Here's the serious delinquency rate, which is anybody who's late by more than 3 months or so, but they don't really go into the details.
Okay. So to ask a question, that delinquency rate, does that include anybody that says, right, and I use air quotes, yes, I will continue, or I can afford to continue, and then the FHA writes that claim, and now what you described as current, are they now no longer delinquent, or does that still really?
Yep, 100%. 100%.
Wow.
Are they really delinquent? Well, arguably, yeah. If you get a couple of these things in succession, you haven't paid in 2 years. So whether or not they're delinquent will fully depend on, whether or not they've crossed 3, 4, 5, and the servicer has talked to them. But yeah, as soon as they bring it, the partial claim is made, then they'll be current for a month, and then they'll probably slip right back into delinquency.
So you're tracking it now, and people can go to your Substack. I'll put it in the notes and so forth. Do you have an idea of how many you think? Maybe caught up in this, just in this whole process of delinquency since this new loss mitigation was put in?
Yes. But there's another pocket of distress that bears talking about.
Let's do it.
Which is the loan modifications. So when the servicer, and I see Charles has left to go take a phone call from his servicer. Or maybe to make one to his servicer. When the servicer asks you if you are able to resume making the mortgage payment, if you tell them no, or if you've exhausted your partial claim pot, right? Because the FHA does have some limit. That limit's pretty high. It's 30% of the principal balance of the loan whenever the first claim is filed. And since these things usually,
so you're saying they'll continue to pile on money on the back end until it exceeds 30% of the total loan?
up to 30%.
Wow.
Is that bad? Is that bad, Greg?
One of my things is obviously, these are loans that typically are very low down payment to begin with. And so, as you increase the principal balance, granted, existing home prices have held up, but at some point you're going to be in that situation back in 2008 where you have mortgages that are in excess of the value of the property.
Well, that's only if the housing prices drop, Greg, which everybody tells me that's never going to happen.
I think I'm being targeted because I'm the youngest one on the show. Just want to
John was just wondering if you called your mortgage.
Oh
broker.
no, I have my AirPods in. Don't worry, I heard it.
Okay, all right.
Hey, John, I'm
Charles,
used to being kicked in the mouth.
That's kind of your
man.
standard line.
So, John, did you throw a number out of how many you think maybe falling under this?
No, I haven't because I want to talk about the mods real quick.
Okay.
Can I ask one question, John?
Yeah.
So just to put like real numbers on this thing, right? So let's just say $100,000 house, FHA, you can do 3% down, right?
Yep.
So you are at what, $3,000? So you're at a $97,000 principal.
Thereabouts. Yeah.
So up to 30%. So what you're really saying is that somebody can have a loan on that house up to $124,000.
Closer to 100, 130, right? Well, I guess 3.5% down. Yeah, somewhere between 120, like around 100.
Yeah.
Thereabouts. Yeah.
Is there any insurance on this? Like they make most people right when they put a down payment on, they can't put a big one on. Do you have to put any insurance?
Yeah, you have PMI, but that doesn't pay for bad.
Yeah.
The FHA itself is, it's basically an insurance program.
It is the insurance.
Yeah.
Okay.
Yeah.
So all the FHA borrowers, they pay an upfront mortgage premium when they originate the loan, which is like I think 1.75% these days of the loan, and then they pay a percentage of annually. So the mortgage insurance premiums are being paid by all FHA borrowers.
By us, they're being paid by us, right?
Taxpayers, yes. That's
I mean,
correct.
In a sense, yes. In a sense, like it. The mortgage insurance fund at FHA is funded by those mortgage premiums.
Okay.
But then the taxpayer is a reinsurer, basically for the for the
Fantastic. Fantastic.
If it needs bailing
at the
out,
end of the
then
day,
Congress will appropriate.
My question to you, John, is it all fails, and so at the end of it, somebody's got to hold on to the bag of shit. Who is that? Is that the taxpayer?
This is a family
BlackRock. It's BlackRock or Blackstone. Whoever it is, they're licking their chops.
That's a
right
good
now.
question
Seriously,
because this comes.
If all the efforts fail to collect and they have to foreclose on the home, who pays the bill? Who's paying that 27 or 24 Charles owes? Because Charles is a delinquent.
Yeah. Ultimately, the FHA insurance fund. And the FHA insurance fund is funded regularly by the mortgage insurance premiums paid by other FHA borrowers. But if, say, housing prices collapsed, right, and a whole bunch of people started going into default and having their house either foreclosed or being forced to sell at a loss. And the fund got depleted, which, to be entirely clear, it's got a lot of money in it right now. But if it did get depleted, then taxpayers would have to step in and fund those. Well, they'd have to fund those payments out of general revenues as opposed to the money that was collected through the mortgage insurance premiums.
So this all gets redone and this all comes due. This change and the loss MIT changes from COVID all come due on February 2026. They're reviewed, and the people that decide, are we going to change these, right?
Well, they're not reviewing them. They've already set in motion that they are going to change on February. On February 2nd.
That would seem to be like the 101 is, stop digging the hole that we're in, right?
But they may not change them either.
Put the track hoe back in the garage.
They
We're
could
not
decide
using shovels here, fellas.
They could decide to kick the can down the road, but is that correct? They could change them. They may not too.
It's not impossible. They could accelerate them forward and have the loss mitigation procedures tighten up again, where you can't string together the partial claims. You can't get endless mods, which you can get today. They could pull that forward. It was originally set to expire in late April, but then the FHA on January 16th extended it to February 2026.
So this whole, just asking a question here, this whole build to rent thing phenomenon that everybody's talking about and private equity's involved in, and these zoning and these postage stamp lots that are, an eighth of an acre with this 1,200 square foot house. It's all funded by, private equity, right? REITs, whoever it is. This is a golden opportunity for these guys. Am I wrong?
Potentially.
You're thinking about three derivatives down the road, Charles, I think. But yeah, where if there's something happens, somebody has to pick up the pieces.
Well, I mean, but that leads me to my next question. So if you say you can do up to 130% on loss MIT claims, right, or minor claims, or the proper terminology dismissed me, I apologize.
Partial.
But if you can do up to 30%, so let's say $30,000 every 100 grand, right, on the actual principal balance. I mean, at some point, somebody somewhere has got to say, okay, we got to get this off our balance sheet because our balance sheet is getting completely destroyed here.
You sell them to Greenland,
right? Sell them to Greenland for their oil resources.
Wow.
Golly. I'm just thinking about how we get out of it, right? I mean, I turned 39 in December, right? I graduated college in 2009. And
wow. You're young.
It was
man.
the worst time since the Great Depression to do anything. Buy a house, get a job, try to do anything in your life, right? So I saw it firsthand, and I'm just trying to think of how as a business, right? Do we prevent catastrophic events from happening? Because this sounds horrible.
Charles, can I preload that question with two questions that'll walk into that? Because here's what I'm thinking about from what you just said. Okay. How much of the run up in prices for entry level? You see, entry level homes are so high right now. Everybody affordability.
I heard one of the big guys is selling 1,000 square foot house outside of Austin for $385,000.
Okay. So how much of this contributed to the last 10, 20, 30% run up in entry level homes? And two, I got to be careful the way I phrase this. How many realtors or mortgage brokers out there know this and with a wink are telling the buyer, hey, you should look into an FHA mortgage because we can get you in at the full price, right? This is everybody listening on here that wants to yell at me about that. This is just me asking a question. I might be stupid about this, but if you're a realtor or a borrower and you want to get somebody to buy that $500,000 or $400,000 entry-level home when they only have $10,000 in their bank account, is this situation potentially being taken advantage of right now?
All right. So to answer the first question, right, like how has this impacted those entry-level home prices? I mean, I don't know specifically how much, but basically there have been no foreclosures or forced sellings of FHA properties over like the last 4 to 5 years. I mean, there's still
There's hardly any, right?
almost none. I mean, basically, you either have to
Wow.
abandon the property or completely ghost your servicer and not talk to them in order to get foreclosed on. It's in part the partial claim problem, but then even if you max that out, then you can keep getting mods. You can get modifications that raise the payment, which makes no sense at all. But the servicer has to offer it to the borrower, and the borrower can accept, and they can accept mods over and over again. So you can start with partial claims and then end with mods after you exhaust your partial claim allotment, and they'll just roll the missed payments into the actual principal balance of the loan when they modify it. So yeah, none of these things. So that's going
So we didn't
to have
learn
an
anything
impact
from 2009.
on- Don't have that supply out there of foreclosures and forced sellings.
So, but this is getting pushed from. Is that right?
I mean, we need to get Doge on this and like tighten it up. I mean, we can clean this thing all up. It's like, hey, first thing we're going to tighten up all this mod scam stuff. And, and listen, there's a lot of this stuff is like, hey, it made sense during the pandemic. We want to do stuff. But, at this point in time, it needs to get tightened up, and we need to start seeing foreclosure sales on some of these properties. I mean,
but it's not actually.
If you've been habitually doing loan mit or loan mod, then it's like you maybe shouldn't be in there.
You probably shouldn't have been in there when you only have 3.5% down.
Is it
on
accelerating?
$500,000 house?
Is it accelerating at all now, or is it pretty steady still? The amount being underwritten in these that fall under the FHA.
I mean, the partial claim numbers are kind of steadily rising over the last couple of months, and I think part of that is because people are catching on to the grift. And
really?
some of it's probably also genuine borrower distress too, right? Like the economy is not in the best place with respect to employment and whatnot right now. So yeah, it's probably a little bit of a reflection of both.
The big question is whether 80% is scamming it and 20% is like really like hardship legitimate, and vice versa, or is it 20% scam and 80%? Either way, I don't care.
Yeah.
So,
I mean, based on
I'm
the partial
surprised.
claim numbers last month, I would say it's probably looks like 35 to 40% are scamming. I mean, if you're getting repeat partial claims within a year,
yeah, that's a red flag.
We want to use allegedly scamming.
Well, and to be entirely clear, like the procedures permit this and allow this.
Of course.
Like there's lots of folks that reply to my threads on Twitter and are saying fraud, but the reality of it is there's likely no actual fraud happening. Like if you attest,
it's a gray area.
It's a gray area.
So this is
It all depends on what the meaning of is.
Well, I mean, all right. So you talk about loan mods, right? So is there a way that the FHA and the mortgage insurance and all of these things, right?
Yep.
They can go ahead and get loan mods to where moving forward, or is this is not as fast process, I guess is what I'm trying to ask, right? Is that fair to change anything? Like, for example, if somebody did their loss mitigation and then said, I wanted to modify, right? When they do that loan modification, would it be permissible for whoever's actually doing the modification to require some sort of documentation showing that the previous history is actually legitimate?
You mean more documentation than just an indication from the borrower that they can make that payment?
Yeah.
I mean, historically, that's what happens with loan modifications. Borrowers had to prove.
Okay, so let me back up. So maybe not that they can make that elevated payment, right, for the loan modification, but in order to get the loan modification and qualify for that there's some legitimacy to that 5 months of missed payments that we had to loss mit. Like, is there any way to say, okay, we're going to implement this process moving forward? Like,
So they
split,
used to do that.
tomorrow.
You used to have to prove the hardship, right? And
That's the
now
best
you
way to
don't.
put it. Not so many words. Sorry, John.
Oh no, yeah, no
Word
words,
salad
no words.
over here.
Yeah, you used to have to prove the hardship, and now the proof of the hardship is not making the payments. That is the literal proof of the hardship. Which, in all honesty, is that's not so bad. It's more like you got to prove that you're going to actually make the payments. Like they could end the partial claim gravy train by just saying you can't get more than one partial claim within 18 months. And that's what they're going to do next February. That's the new standard. You can only get one partial claim within like every 18 months. That'll stop a lot of the nonsense. And
how much will that hurt housing? How much will that hurt new home sales though if they did that? Like,
see that gets into the question of what's the sort of impact that this is going to have. And from a numbers perspective, there's about 150,000 loan mods that have been performed over the last roughly 2 years that I don't think have much chance of being viable once real loss mitigation happens again. And a lot of these loan mods were devastating to the borrower, right? Like because if borrower had, say, a 3.5% rate that they got on a home that they bought in the pandemic,
Got a loan mod at 7.25%.
Exactly. And like they'll apply all those partial claim funds because you can combine a modification and a partial claim to reduce the principal balance. And they have to do that because if you're going to jack the rate 3 points, then you're going to, hugely spike the payment. So you got to lower the principal as much as you can. But even then you might get a, 5% payment reduction. And if that's not enough, now the borrower's out of loss mid ammunition. And the next time they get a mod, they'll get it, but it'll raise the monthly payment because now they've got 5 more months of missed payments they need to add to the principal. And there's like 150,000 of these things that are out there it's just like if rates collapse between now and next February, then some of these mods will have a chance. But if they don't, then
is there
all these delayed forced sellings that have been kind of building up behind this dam of incredibly permissive loss mit procedures, they're gonna kind of come out in rapid succession. And then whatever percentage is like legitimately unable to make their payments, who's getting partial claims right now, and that's what I don't know. I don't know how many of those are.
Is there a kind of a perverse incentive with the mortgage servicers because every time they do this, they get to clip a little bit of a coupon?
No,
whether it's a mod or a partial.
It's like the Wall Street Journal article kind of went in that direction. And there is a perverse incentive for a mortgage servicer to do loan mods as quickly as they can, right? So, get on a texting basis with Charles and be like, Charles, we're going to do this every 4 months. Like as soon as you're serious delinquent, you get those papers back.
You got his number already, John. Yeah.
Oh boy.
I mean,
I got the strongest back. I can carry the heaviest load. What can I say?
John, we're the #1 podcast in the lumber and building materials industry. I have usually we're like really deep in the weeds on like the trading aspect and all that stuff. This is mind blowing, and I think could potentially take us next level. We're not going to go Rogan yet, but I think
Question: I wanted John to show us a couple examples that he had teed up, but also my question was, out of those 150,000, what areas of the country are they heavily dominated in? Like, where are they sitting? A lot of them. What part of the United States are they more in the Sun Belt areas or?
Yeah, they are. Running the numbers on the numbers on the mods in any event, the 150,000 mods that I don't think will be viable when real loss mitigation. There's a pretty heavy concentration in Texas, Florida, Georgia. Like California's got less of a less of a concentration. And I'm kind of doing a rough adjustment based off of population for the states, right? Like you expect California to have more naturally because there's more people there, but when you adjust for population, there's a concentration in Texas, Florida, and Georgia for sure.
Could you throw us up some examples so we could take a look at them quick?
Yes.
Ash loves to geek out on spreadsheets.
Well, no. So, John, what do you do every day? You post the loss mid of the day, or what do you usually post when you're throwing stuff up on X? Like,
it's the FHA loan of the day. I go find the most entertaining, egregious examples of gaming the system. And this is today's FHA loan of the day that I posted a couple hours ago.
How do I make this screen
so,
full?
Unlike most FHAs, and I'll admit, like I often pick some of the higher value ones, because for entertainment value and whatnot.
Can I ask a question?
Yeah.
John, usually I don't have these kind of manners because we talk all over each other, and Greg's kind of a bull in a china shop, and he likes to run over everybody. So thank you for showing us a little bit of class and manners. First of all, hold on, Greg, I'm not done.
Charles, I want to hear what you have to say right now.
I appreciate that. So when we think about a low down payment loan, and something being insured by the federal government, is there not somebody somewhere that says, hey, we probably need to cap that at $400,000?
I mean, they do. They have loan limits. They're just higher, particularly in some spots and higher in counties that have expensive homes. I've got some $1 million loans in there. Yeah. FHA loans.
At 3% down payments?
Huh? Yeah. Well, 3.5, but yeah.
Oh, my semantics, John. Semantics.
Yeah. So what was the one? The one today was
a $913,000 loan at 6 3/4 points.
I'm sorry, I missed the last part. $913,000 loan in California. Actually, I believe we are. It's a 2-unit property, and the borrower makes the first payment. But then stops, right? And what I do and I don't know how well this will show up.
So they're getting rent on the other property.
Maybe both.
Presumptively. I mean, unless they're not charging the tenant in the other unit, or maybe
you can't make this stuff up.
So they make the first payment, and then they don't make any payments until they get this partial claim. How much is that partial claim? Well, I mean, the partial claim will bring it current, so it covers missed principal and interest, and it covers missed taxes and insurance. It's about $7,000 a month on this property. So the FHA paid about $70,000. They covered the 10 missed payments. The borrower promptly started missing payments again, but then it looks like, hey, maybe the borrower came current. Maybe he's just struggling and isn't gaming the system. The problem is when we come down to the check bounced. We come in and take a look at the payment history again.
Oh my God.
204. All right, check balance. Here we are. Still no payments since the one payment that they made. They get another partial claim for, I think this one was for $70K too. And then they immediately go delinquent 3 months, which brings us up to February. This is the last data point that I have on the loan. So they've up to this point they have amassed.
I think we can all probably.
I probably need to wear readers because I can't see that at 30.
Yeah, but I think we can all probably agree that this one probably needs a little special attention. And hey, let's get foreclosing on this property because this is scam.
100.
Did you have a chart you wanted to show, John?
Chart? Sure. It's a little.
Yeah.
Well, yeah.
I'll see if I can make it larger on here
Ash,
for Charles.
You see that? You're like top 5 people in his messages on the side. Did you see that?
How's that?
I don't know. I just saw it on his X.
Oh,
or whatever it's called nowadays.
Okay, so what this chart shows, this chart shows the delinquency rate trends of various kind of subpopulations within the FHA portfolio, right? Like lots of people track what the headline delinquency rate is for FHAs, but that doesn't tell the whole story at all, right? You have to look at the various subpopulations to really understand. And that's what I've been doing, and that's what kind of differentiates my work from what you can get from Black Knight / ICE these days, or the FHA itself. And this chart's a really good chart, because if you look at these two dotted lines, and this is the non-HAMP and HAMP mods post-spike. So these are the modifications, that 150,000 population of modifications that I'm so concerned about. And you can see for the ones that are still in MBS, that are still in the MBS pools, they're running at like 47, 40.5% delinquent. And you compare that to the rest of the portfolio. You've got some pre-spike mods that aren't performing great, but then you get down to the rest of these are the purchases and the rates, refis, and whatnot, and it's not great, but it's a different kettle of fish than the 40 in those mods. And you see the same thing when you get into the serious delinquency rate trends. And what these charts don't include is that these numbers up here are actually closer to double, because there's, for half of them that were originated, they've already been removed from the pools because of serious delinquency, to either get modified again, or because the servicer is trying to manage their cash flow, because they still have to pay the investors, and sometimes it's easier to not pay it out, but instead pull it back from the pool and fund it themselves. So the real delinquency rate on this set of mods for any given month is closer to like 70%, down to like 55% serious delinquency. And you miss that in a headline, 10% full portfolio or 3.7% full portfolio serious delinquency rate. You don't understand that.
Did they catch that in some of the articles that have been out in the last month or something? How delinquent they really are?
Have they caught it?
Yeah.
Not with the subpopulation that I've been identifying. No,
yeah.
Not that I've seen. No, it's kind of what's differentiated. Like the Wall Street Journal piece intimated that it was, the recent borrowers. But if you go in and you look at the recent borrowers, which, let's see if I can scroll down to that real quick. Performing a recent origination.
This is all in your Substack, right, John?
Yeah, all in my Substack. The recent originations, again, excluding the mods. If you go back over a 3 to 15 month look back period, those loans are not performing, fantastic, but 7% delinquent, serious. It's just, that's not the story. The story with loans originated, because it includes the mods, are these mods that are just in disastrous shape. And those are the ones that when they fix loss mitigation, they fix the bug, so to speak, and start doing real loss mitigation again. That's what, it's just difficult to see these things viable at all.
Matt?
Question for you, John. Those really poor performing loans that you're highlighting, do you believe that that's intentional? Is it your opinion that that's like basically fraud or an intentional
it's a game playing,
subverting of the system?
Some of it.
I think for some of those mods, if you've got a borrower who knows their loan is doomed, then they're going to probably take as many mods as they can until the music stops on them, right? For the others, there were a lot of these mods that were performed that were, in retrospect, heavily disadvantageous to the borrower, because the borrower said the wrong thing to the servicer when they asked the question, can you resume making the mortgage payment? So if Charles had said no, in that situation, then they would have put him into a mod. And in 2021, that was fine. That was great, because he's probably going to get a lower rate. which is going to help to lower his payment. Probably doesn't even need to dip in maybe to his partial claim pot. But instead, for the ones that did it in 2023, they had their rate jacked up 3 points. Then they exhausted their partial claim pot, got very little payment relief, and now they're hosed going forward. So I don't think that was intentional. It was just an effect of a bad policy, like it's abject FHA policy failure is what it is. And what's frustrating is the FHA knew this was a problem. It's why they developed a whole new program that just came out that lets people tap into partial claim to reduce their payments as opposed to just covering the arrear. It'll help reduce your payments for a couple of years. But it took them a year and a half to roll that out. And there were 150,000 borrowers who got hosed in the process.
So John, you're an expert at this stuff. That is evident. The data that you have shown us today is impeccable. My question, based on your background and your knowledge level, we're just a bunch of lumber guys. How do we solve this problem?
Well, I mean, there's two things.
In your professional opinion, right?
Yeah. And there's two things to solving it. The first one is for the folks who are getting strings of partial claims, like the loan of the day that I showed, they just need to stop that immediately, right? I mean, who knows whether or not that borrower can pay? Why would you pay when I can get a 30-year interest-free loan from the FHA to make that payment? I mean, sure, it wrecks your credit, but you already got the house, so maybe you don't need credit if you're getting an extra $7,000 in your pocket each month. So that's part one to fixing it. And then with respect to the 150,000 that are sitting out there, I mean, that's a tough question. I mean, it's a tough policy question because the FHA's actions really did not help these borrowers. But then these borrowers are not paying, and there's the other side of the equation where there's many folks who are millennials and Gen Zers who can't afford to get into a starter home because the FHA is effectively paying the mortgages on all these mods and
people that beat them to the punch, basically.
Yeah, some of the partial claims. So
sounds like in a lot of markets, it would probably be helpful to kind of start clearing the deck and would have
identify a liquidity partner. Yeah.
Well, I'm just saying is, so we look at, like existing home prices have held up so strongly, partially, we've been saying it's because of the lock-in effect on all the people with low rates, but it's also, in fact, is we haven't had any foreclosures for 3 years.
Yeah.
And, the pandemic, unless I'm missing something, I mean, that was a long time ago. I mean, I miss it a lot. I mean, I would love to have COVID come back. Greg. I mean, those are the best. Those are some of the best years.
I actually like to see you in a mask, going forward.
The real face
on the show. On the show.
John, so you're doing this
every time I see you. You should have a mask on from now on.
You're doing this on your own now. Like, what type of, like, I could see traders wanting to contact you, large companies that are interested to see what's going on, private equity. Like, how can they contact you? What do you, what can you provide now as a service for some people looking for this information?
Yeah. So I publish the Reverse Engineering Finance Substack, which they can find. It's actually johncomiskey.substack.com is the title of it, where I publish, both articles like this and then underlying data, and I'll be expanding the data that I publish through the site as to kind of what's going on for if there are MBS or mortgage-backed securities traders out there who want to maybe get an edge in terms of determining which loans and which pools are going to prepay faster because that bears on their business. And then eventually I'll start grouping these things together by servicer to try to get an idea of which servicers are going to be exposed because they're servicing a bunch of these, 150,000 mods of doom, I dubbed them.
We're going to have a movie and a book about this one day.
So the Big Short too. all the mortgage
The
companies,
longest short.
all the mortgage companies and originating brokers that just want to send you 100 million worth of Bitcoin to make you go away. Where can they send that to your wallet at?
I'm
Yeah.
sorry. Say again. Where can they send me
All
money?
the big mortgage brokers and real estate companies just want to make you go away. Like, where can they send the 100 million of Bitcoin to? Because I mean,
Well,
what you're doing,
if they want to do that, then they should, either subscribe to my Substack and just, send me a private message, or they can follow me at Twitter at John Comiskey 77.
yeah.
And shoot me a DM. DMs are always open to offers of money for sure.
Because what you're saying,
Especially Bitcoin.
what you're saying right now, it probably doesn't go over well with a lot of people in the mortgage and real estate side of things. Like you're a truth teller. You're seeing what you're.
Well,
what
you're
seeing.
a contrarian to the warm and fuzzies that everybody's experienced over the
Yeah.
past 3.5, 4 years.
This has
It's
been awesome,
refreshing,
John.
man.
I mean, I'm hoping that we're going to be able to do a follow up here in a few months and get a real, like an update. And I mean,
Sure.
I think hopefully we can get some policy change out of this. I mean, when when Elon listens to the pod in a couple of days, he may, put a couple of tech pros on this.
Well,
I'm
Ash has got to do the pod from his Tesla Cybertruck.
Right. Yeah. Before he gets firebombed.
By the bicyclist.
Well, John, I really appreciate you spending the time today. And also, this is the first live one we've done in a long time on video.
Yeah.
So we're going to repackage it, keep the video out. It'll be live on the X Stream. You can repost it on my X Stream. And then we will repackage it as a podcast tonight so we can listen to it. But it's live on LinkedIn and on Twitter. At least that was the game plan. I'm going to check to make sure.
Yeah, we'll see.
I did my part on LinkedIn and reposted the live.
Hey guys, awesome, great to see you. We'll see you next week.
Thank you, John.
Yeah.
Thanks,
man.
Matt,
Thank y'all.
Charles, Greg.
Thank you,
Pay your
John.
mortgage, Charles. Pay your mortgage.
I do.